You've done a really good job of building up your retirement plan, and you have extra resources that you can use for future expenses. So, how do you use this surplus to safeguard your plan against the high costs of long term care? That's what this presentation is about, to show you ways on how to reposition those additional dollars for greater support in long term care and legacy planning. My name is Erich Castillo. I'm a financial advisor with 30 years of experience, and with healthcare costs rising and long-term care expenses just going through the roof, this is a big concern for many people that we talk with. Now, most people save and invest over a lifetime for three big reasons: income, legacy, and future expenses like long-term care. The question is, does your current plan actually cover all three, or is it quietly betting that you'll never need serious care? I'm very passionate about this topic because I see time and time again the impact that this cost has on families. According to the Department of Health and Human Services, 70% of people who reach age 65 will need some form of long-term care at some point in their lives. But only 3 to 4% of people over age 50 are planning for this cost. And with costs rising, like in 2025, it's about $10,000 per month. We need to build a plan to give you more confidence during your retirement years. Now, for years, long-term care planning has been built on compromises and trade-offs. That's about to change. What I'd like to do now is introduce to you my friend and colleague, Louis Hillman. Louis' firm has discovered a way to remove the compromises found in traditional long-term care solutions, enabling families to safeguard their retirement income plans and maintain wealth for future generations. Louis is president of Optimus Producers Partners and is someone I've known and worked with for almost a decade. And I'm really, really impressed with what his team has developed. And frankly, it's offering benefits and flexibility in an industry that's never been seen before. So let me introduce to you Louis Hillman.
Thanks a lot, Eric. You've officially made me feel old, putting out there that we've been working together for a decade. It's actually incredible to think about the great work we've done together. And ever since I met you, I've known that this is a topic you're really passionate about because of what you've seen firsthand in your life and then with the families that you work with. We're really excited to rethink and reimagine how people can help solve this. And, it's a topic that people don't like to talk about because there hasn't been a great solution previously. And a lot of advisors have ignored it because they didn't have something they felt that they could take to their clients without making those sacrifices. We feel like we've come up with a solution that eliminates the trade-offs. This is a topic that matters now more than ever. We have an aging population. You'll hear the term silver tsunami because we have so many people retiring, and the need for care is going to outpace the ability to deliver it with quality care. So families that take control around this topic sooner than later will have the best outcomes. Medical advancements are extending people's longevity. So not only are people living longer, they're living longer while sick.
Yeah.
And it's a good thing that people get to live longer and be with their families longer. It's also draining their assets for a longer period of time. So as we continue to have these medical advancements, people can expect a larger share of their retirement savings to have to go to pay for care at the end of their life.
Yeah, and when I'm working with my clients, this is a big concern. We've looked at traditional approaches, but right now the world is changing. And so, with that in mind, what do you see are some of the limitations and trade-offs that come with traditional solutions?
Sure. Well, with traditional long-term care, you lack any guarantees. Premiums and benefits are not guaranteed. Your clients probably have parents that purchased long-term care insurance, 20, 30 years ago, and they felt the pinch of having to make that tough decision to pay more or reduce the benefit pool. A lot of advisors have felt burned by that product line because it fractured the trusted relationship with their clients, where it's not what they thought they bought, right?
Yeah.
So out of that came hybrid or asset-based long-term care products that are tied to a life insurance or annuity benefit. But the challenge with that is, by putting the money into a product like that, you usually forfeit growth of the asset, right? So you are trading growth for protection. And a lot of times people don't like forfeiting the growth of their money, even if they know that they need the protection, in this case, the long term care protection. So, single product hybrid solutions, a lot of times people have purchased them not actually addressing the need. They'll insure some of the risk. That's the limitations of that product line.
Mm-hmm.
And then you have life insurance products that have long term care, chronic illness riders. And the risk with those products is if you're using the products the way they're intended to be used, where you're actually taking tax free retirement distributions, what's happening is you're depleting the benefit pool. And by the time you get to the age that you need the chronic illness or long-term care benefit, your benefit pool is actually very limited. So now you don't have a meaningful amount of coverage to pay for long-term care expenses.
Yeah. And a lot of those options, it feels limited or really expensive for clients to continue. I know with my mom, she has a traditional long term care policy, but it seems like every single year that policy premium continues to go up by 20 or 30% just to keep up with the cost of long-term care because these insurance companies didn't underwrite it properly. And we're seeing that across the board with clients that we're working with when it comes to traditional approaches. The side part of this is, well, why don't I just take the money and invest it, self-insure it? Why is self-insuring a bad idea even for wealthy families?
Well, let me just start with your average family. Couple things. The first thing is if you consider the current cost of care. Obviously, it depends where you live and the quality of the care, but let's just say it's $8,000 to $10,000 a month. With just a simple inflation calculation, 20 years from now, it's going to cost over $200,000 a year to receive that same care, right?
Right.
And what we have found is that most of the families that we work with, the way they expect to pay for their care is with their qualified retirement savings, their IRA, and they've mentally earmarked some of those dollars for either an unexpected health event or money that they intend to leave to the next generation. So the way they think is if they need the care, the money's set aside. And if they don't need it, they know it's earmarked for their beneficiaries and an inheritance and a legacy. But the problem with that is they're not really thinking through or finishing the math of what care will cost in the future when they need it. And if it's going to cost $200,000 a year in 20 years to pay for the same level of care, and the client has said, I want to use my IRA savings, well, you're going to have to distribute $300,000 net of taxes to pay for the $210,000 long-term care bill. Right. So if you then go through several years of care, because on average, men need care for about 2.5 years and women need care for about 3.5 years, an average family will need 6 years of care. That's if they don't have a cognitive event, because now people can live longer while being sick. We hear firsthand or secondhand stories of somebody that they know that has been going through a long-term care event, a decade or longer, which is devastating on assets. So a family going through 5 years of care is going to have to distribute millions of dollars from their IRA. So they don't have the assets to deal with a devastating long-term care event. All of the good planning that you can do to work hard, to save enough to retire, to build an income plan is completely thrown out the door. It's like a wrecking ball coming through your retirement. And nobody can forecast if they're going to be the family that has a long-term care event that completely devastates the retirement plan.
Well, so many people know somebody that has either needed care or assistance. My mother-in-law was diagnosed with Alzheimer's, and for 12 years, my father-in-law cared for her at home. Fortunately, they had benefits. It's already emotionally draining, but financially, it would have been taxing if they didn't have a plan in place. It's expensive now. What you're saying is it's going to be really expensive moving forward, and that cost is not coming down anytime soon.
Well, I'm glad you shared that story because that's another anecdote that we have heard time and time again where families, because they have limited resources, and that may include their long term care policy, what they end up doing is they delay care as long as possible. So they delay the financial devastation, but you now have an emotional and a physical impact on the spouse caring for the sick spouse, all to delay the actual professional caregiving, which is why we have taken the approach of let's create a benefit pool that is literally unlimited. There's a way to do that where you don't have to make that decision to delay care. As soon as one of the spouses needs it, they can start benefiting from the planning that we've done. And it's impossible to measure, but that spouse that has the physical and emotional toll of caring for the spouse that gets sick first, what does that do on their longevity and their morbidity? They probably don't live as long, and they probably end up needing care sooner because of that toll that it takes on them.
Yeah, 100%. Planning ahead is key when it comes to addressing this need, but you have to be very flexible around that. And we're going to be talking about that flexibility where we can take their resources and provide a benefit that is long lasting.
Well, I do want to answer the other part of your question. Wealthy families, right? This is one of the biggest misconceptions across the financial planning industry. The idea that, oh, my client has enough assets that they can self insure. And I want to tell you, that's a bad idea, even for wealthy families. Here's why. A lot of families that have created significant wealth have used leverage to accumulate that wealth. We're now showing them a way to leverage what they've accumulated to then preserve the wealth. And studies confirm that wealthy families care just as much about this topic as average retirees. So I believe that it's actually the advisors that are the gatekeepers to wealthy families implementing this, because typically they're going to trust the advisor's recommendation, right? Rarely are they going to push back on that. But not leveraging the wealth today to preserve against a financially devastating long-term care event impacts what is left for the next generation. So a lot of times we would say, get the kids in the meeting because they're going to have an opinion about this, and they may agree that this is actually responsible use of the wealth now to preserve what is left for them and the grandchildren.
Right. Well, and my mother in law was a homemaker. My father in law was a teacher on a pension. But when we stress test their plan, the weak point was not having enough money to cover long term care should that come up. And when it did, having that plan in place allowed my father in law to still maintain his lifestyle. He didn't have to sell off assets, sell the house. He was still able to preserve a legacy for the kids. And the statistics prove that many people age 65 and older, they're going to need this type of care at some point in their life. Our family is living proof that it doesn't matter how much you have, having a plan in place is vital to preserving your lifestyle and legacy so that you can live your best life forward.
I'm really glad you brought up the idea of the stress test, because I would venture to guess 99% of American families would fail the stress test against a catastrophic long-term care event. Again, it's like a wrecking ball coming through your retirement plan. You can do everything right. You can work hard, save diligently, make all the right decisions, and get to retirement and have a great plan. But all of that comes crashing down if you have a costly long-term care event that could last for years and years and years. What are the greatest risks in retirement? People talk about taxes. People talk about market losses. If you had to put a percentage to those things, those are fractional risks. This is the biggest red light flashing risk in retirement. If this happens and you don't have the right plan in place, nothing else matters. the money you allocated to this investment versus that investment. It doesn't matter. It's all gone. Deciding to purchase an income annuity to protect against market losses. Doesn't matter if all of that money has to go to paying for your care, right?
Well, and a lot of advisors don't plan that expense in their structure, but it's the what ifs. What if you have an event that requires long-term care? What does that look like, and what's that projected cost? Could your family sustain an extra $10,000 to $15,000 a month to cover this care? I mean, with inflation, how high it is today, now add to that $10,000 in today's dollars. 20 years from now, that could be $20,000. Where does that money come from? Louis, your firm created a breakthrough in how long-term care protection is designed, funded, and delivered. Share with us a little bit about that design. What does that look like, and how does it benefit across the board?
Yeah, well, I'm excited to share it with you. So, thinking about all of the limitations we covered with standalone single product solutions, we wanted to build something that optimizes how different insurance products work for a customer, where we could preserve the legacy and not have the long-term care benefits reduce what's left over in a life insurance benefit, eliminate the finite benefit pool, and have unlimited benefits. So if you are the family that has an extended long-term care event, 6, 8, 10, 12 years, you're not worried about running out of benefits. And then we wanted to have the client not forfeiting the growth and access to the money. That is one of the biggest trade-offs of traditional long-term care or life insurance or annuity-based products that have long-term care benefits as part of the package. Usually your money stops growing and you have less than you put into the plan. We've created a way that you can actually see the money continue to grow for the rest of your life and have access to it while you create this unlimited benefit pool of long-term care coverage for both spouses. So both spouses can be on claim for as long as they need the coverage, but it's not depleting the legacy. The life insurance is separate. I'll show it to you visually. So what we have found is that most families that are going to be ideal for this are going to have IRA or tax qualified retirement savings in excess of what they need for the retirement income. So to go back to the idea from earlier, they've either consciously or subconsciously earmarked a portion of that IRA for typically the two purposes. If I have an unexpected health event, this is money that I will use to pay for it. Maybe they think it's just emergency money. And if I don't have the emergency, then it's money that goes to my kids. And we're saying it would actually be a catastrophic mistake to leave that money where it is if that's the intent, because we can recapitalize it now for the primary purposes of having lifetime long-term care benefits. Long-term care coverage you and your spouse cannot outlive with inflation. Well, preserving an inheritance, a tax-free life insurance death benefit, that means more than what you put into this whole plan goes to your beneficiaries. You don't have to worry about the long-term care event spending down the legacy, but we can do it in a way that the client still has growth of the money inside the package solution. So we're using multiple products in combination with each other to deliver a better outcome. So the client can comfortably reallocate the money, knowing that it will still grow and they still have access to it while they also receive these other benefits.
You're not just using one product, you're using a combination of different tools. It's like building a house. You're not building a house with just hammer and nails. You're using different tools for specific purposes, but the combination and putting it all together is what helps solidify making sure you have access to the funds, creating that legacy, and providing for what could be a very expensive cost at some point in the future.
Yeah, people don't like talking about long term care because usually there's some emotional pain point that devastate a family member or somebody close to them, both financially and emotionally. And people don't think it will happen to me, or I don't want it to happen to me and my family, so I don't want to think about it. Historically, there haven't been great solutions, which is why advisors have ignored this. They don't want to take something to their client that upsets and fractures their trusted relationship. For example, traditional long term care insurance, where you described your mother in law having constant premium increases or benefit reduction decisions. That's not fun. This has been an area that people have ignored, both advisors and clients, for different reasons. And we're saying, take your head out of the sand. We've got a reason to actually look at it again and feel really good about how you allocate your money into this package solution, LifeBridge LTC, because we are eliminating most of the trade-offs, if not all, that come with single standalone traditional solutions.
That's great. Louis, what are the limitations and trade offs that come with traditional solutions?
Yeah, what we have found is that because there are not a lot of great options, advisors end up not presenting anything to their clients. If you think about the evolution of long-term care, you have traditional long-term care insurance, like homeowners insurance. It's a use it or lose it proposition, right?
Right.
You pay high premiums for something you may not get any benefit out of in the first place. There's no cash value, and rarely do those products have any kind of death benefit. So the clients would recoup a portion of their premiums. But the biggest pain with those products is the lack of guarantees. Families that have purchased traditional long term care have had to make the tough decision over and over again to either pay more premiums to keep the same benefits or reduce their benefit pool. And it has really fractured many trusted advisor client relationships because it's not what people thought they bought. The policy wasn't guaranteed. So advisors just stopped selling it because they didn't like selling a product that made their customers unhappy, you
Right.
know?
Well, it just got more and more expensive throughout the years. Insurance companies didn't plan for the huge costs. They didn't plan for people living an extra 10 or 15 years. And somehow that has to be made up, and they're making it up in higher premiums. So it's forcing people to make tough decisions, but it's coming at a huge cost.
Well, and if you think those are expensive, the evolution of asset based or hybrid long term care products where the benefits were tied to life insurance or annuities, in the sense that everything is guaranteed, requires a lot more premium. So those products are even more expensive than traditional long term care. And they do have features that eliminate the use it or lose it objection that people don't like with traditional long-term care. For example, the hybrid long-term care products tied to life insurance, if you don't use it, the amount of life insurance could be much less than what you've paid in premiums, right? So it's a
Right.
nominal amount for long-term care benefits. Or there's products that have riders on cash value life insurance, like an index life insurance product. But the reality is the way those products are structured, the client is expecting to use the product for some retirement cash flow. So any of the distributions that they're taking is concurrently reducing the life insurance amount. By the time that they need care in the future, there's a limited benefit pool because they've taken money out of that account. They're imperfect. Single standalone products, you're having some trade-off to put that into the overall plan.
Yeah.
And that's why we've developed a solution that we feel does a great job eliminating those trade-offs we know customers have with traditional standalone solutions.
Well, and we've seen clients lose control, and they don't want to lose control. That's really important to them when it comes to a design to make sure they have that flexibility to have access to funds just in case.
Yeah, people don't like having to make the decision to forfeit growth for protection, which is what traditional long-term care products do. You are trading an asset that can grow unencumbered for something that has very little or no growth but you're adding the long-term care protection. We've wanted to figure out a creative way to not lose control and growth of the asset, but still deliver the long-term care and preserve a legacy. And obviously, that's why we're here talking today.
Awesome, Louis, and thanks again. Who are the ideal clients for your platform?
Yeah, I'm going to start with the one that I think is the most likely candidate for LifeBridge LTC. It's your clients that have IRA tax qualified savings in excess of what they need for their retirement income.
Right.
And I will make the case that not doing this plan is a mistake because that client is either consciously or subconsciously earmarking those dollars typically for an emergency and usually a healthcare event. And if I don't have an emergency, that's money that will pass on to my beneficiaries.
Yes. Yeah.
And
Yeah. So let's make sure income is taken care of first. And then what is the surplus? It's either for those expenses that may pop up or you want to leave money to the kids. And what you're saying is there a way to combine both of them within your concept.
yeah, if you actually complete the math equation of what care will cost in the future and how much money you have to take out of an IRA net of taxes to pay for that care, the money that the client has subconsciously earmarked is all gone. The IRA is gone, the legacy is gone, and now everything else is infringed upon. The income plan is now exposed because there wasn't a plan in place to cover the actual need. So, not doing something is very risky. That's where we are doing the most work with retirees and pre-retirees. But this is also a strategy that high income earners can deploy. We can use their income and their non-qualified savings as part of their overall plan. And then we're doing work with business owners on this strategy as part of the future sale of their business and an exit from that business. It's a little bit different because that business owner selling for one lump sum is getting one big check, but it's similar in the sense that they've got to retirement now and they're trying to come up with what does that plan look like, while the biggest threat to that plan working out is not did they sell the business for enough, how much were the taxes on the business sale, it's what happens in retirement if you have a long-term care event.
Hey, Louis, if you don't mind, can you share an example with us? I think you've got a client that I'm working with right now. We've taken care of their income needs. So there's extra money in their IRA account. What is that impact if we were to pass that along to the next generation? And what can we do with that extra surplus? In their situation, they were looking for a way to cover long-term care expenses, still keep up with that long-term care inflation that might happen down the road, and still leave a legacy if they don't use these funds for long-term care.
Yeah, so the clients have about $1.2 million in their IRA and they have all of their retirement income needs met separately, right?
Mm-hmm.
So net of taxes, the $1.2 million is worth less than a million, right? So what we've done for them, number one, is we've secured a death benefit immediately worth $3.4 million. And then depending on how long they live, could grow to exceed 5 million at age 100. So we've leveraged those dollars into a tax-free legacy while providing each spouse $10,000 of care today per month, per person, $120,000 a year, with a 3% inflation, will provide $217,000 at age 85 for both spouses. So they would be able to receive over $400,000 a year if they were both in a long-term care situation. Going back to the conversation about control, we're not giving up growth and access to the money. We're reallocating it into this insurance solution where by year 10, the cash value is almost equal to the pre-tax value of the IRA today. So we've paid the taxes and the asset is growing and will continue to grow. They don't expect to need to tap into it, but if they did for any reason, they can. So
Right.
this is trying to eliminate the trade-offs of single product solutions where, yes, a life insurance or a standalone long-term care policy, you could get the death benefit or you could get the long-term care, but usually you would have to forfeit growth and access to the money. You wouldn't have an increase in cash value. You would probably have a declining cash value. So clients didn't like that. They wanted the benefits, but they didn't want to give up control of the money.
Yeah. And what is really compelling about your program is to access the funds. You can do that, if done correctly, tax free. If a person passes away, the death benefit is tax free. So in this case, it starts off at 3.4 million from that 1.2 million dollar account. And then if they need it for long-term care, it's tax free as well. So there are significant tax advantages built in this plan to enhance and complement one's retirement savings. Is that correct?
Every single benefit on this page is tax-free.
Yeah. So this client had $1.2 million in retirement, but it's not really worth $1.2 million because they got to pay taxes on that money. So when they're paying taxes on that money, it goes to that next generation. It's not $1.2 million. It might be $900,000. You're turning that $900,000 into a $3.4 million tax-free benefit with long-term care and access to funds.
Yeah, in some ways we feel a little bit silly because this was right in front of us the whole time of combining products to maximize long-term care planning. But the time is right because of that silver tsunami, and our country needs a solution like this. Families need a solution like this where they can make a decision to allocate their money strategically so they're set up to not have to worry about that big wrecking ball coming through their retirement plan.
Right. So what are your thoughts on a Roth conversion compared to this plan?
Well, a Roth conversion doesn't address the catastrophic long-term care event, right? We could argue for days if it's mathematically advantageous to do a Roth conversion. Are taxes going to be higher in the future? Yes, but are they going to be double what they are today? I don't think so. So Roth conversions to me have minimal benefit to the client, and you don't provide any additional protection against that catastrophic long-term care event. Somebody would be concerned about taxes or market losses. Those two things, in my experience, completely pale in comparison to the risk of a $300,000 a year long-term care event in the future, depleting assets, blowing up a retirement income plan, eliminating any legacy that would be passed on to the next generation or generations. Will they have a long-term care event? How long will it last and how costly it will be? It's the worst way to think about spending your hard-earned savings, and there's a way to prevent against it.
Right, right. And what I really like is when it comes to the plan that you're bringing to the table, we don't have to make trade-offs. So in closing, Louis, do you have anything else that you wanted to say?
Well, first of all, I just appreciate your passion for this topic because I work with advisors all over the country and we need more Erich Castillos out there. So thank you for the work you're doing. Your clients are lucky to have you because most advisors ignore this topic.
I appreciate you and your team, what you're all doing, and looking forward to working with people that are watching this video. If you'd like a complimentary assessment to address how to pay for long-term care and to look outside the box, then there's a link below where you can set up a time. And in that meeting, what we'll do is just talk about your situation, get to know you, and create an assessment that's going to give you confidence when it comes to your overall retirement plan.